This is my go-to strategy in bullish markets. It's called the 1-1-1 strategy. It's super profitable. It has a 95% plus win rate when traded correctly. And in this video, I'm going to walk you through exactly how to place it and make it work for you step by step and why it works. Starting off, here's a back test of it. You can see here 82% win rate, which is very good. Average win of about $1,200, and an average loss of about $1,500. Why is this amazing? Because our winners and our losers are roughly equal. If you've been selling options for any amount of time, you know that when you sell options, your losses are typically astronomical compared to the small profits you take. This one is about equal, which is amazing because with an 82% win rate, it then just gives you a consistent and very profitable return over time. This is the same strategy that I taught to all of my coaching clients, and it's our go-to strategy in bullish markets depending on your account size. So how exactly does a 1-1-1 strategy work, and what are the rules? Okay, a 1-1-1 is essentially a put selling strategy. If you don't know what put selling is, you pick a level where you think the market will not go below. So for instance, if I'm betting way down here, 5,200, and I think, hey, the market will not get below this level, that's what I'm betting on. I am selling a put here, SP for selling put, and as long as the market stays above this level, I make money. Which means if the market continues trending up, I make money. If the market goes sideways, I make money. And if the market goes down but stays above my level, I make money. This is why it's an amazing strategy, because it gives you so much room, so many possibilities to actually make money. You only lose when it starts breaking through your strike price, and then you're actually going to be in trouble, and that's why we have stop losses. But moving on from there, that's the first part of the 1-1-1 strategy. The next part is buying a put debit spread. So we come up a bit higher and we do a put debit spread. A put debit spread is made by buying a put and selling a put. This creates a put debit spread, which caps our risk, caps our upside, but makes money to the downside. This is essentially a hedge. It profits as the market drops. And so this way, as the market goes lower, this hedge increases in profits and makes us money. So how does all these things combined make a return? The short put makes us, let's just say for rough numbers, would make us about $1,000. And the put debit spread would cost us about $200. So these two things combined net give me a profit of about $800, which isn't bad considering that this hedge can make me a lot of money if the market drops to offset any losses from here. So that's how it works. Your short put is financing or paying for the cost of the hedge so that you can have downside protection, but you're still ending up with a net profit. Now, if you're wondering why is the trade called a 1-1-1, because we buy one put here, we sell one put here, and we sell one put here. Now, what is the structure of this trade? How do we do it? What are all these puts located at? And so again, all these puts are done in there's a certain level we pick for them, and this is how it's done. This trade is primarily done on an overall market, so that being something like SPY, SPX, an index, something like that. I prefer to do it on futures because it gives me the greatest leverage, tax advantages, things like that. So ES, for example. Now, how far out in time do you go? You go between 90 to 120 DTE. Why this far out in time? The further out in time you go, the more time you have to be right, the lower your volatility risk, the higher your theta decay profits, and so much more. So that's why I love going out at least this far in the future. So we're going 90 to 120 DTE, my favorite being around 90 to 120. So again, I tend to fall somewhere within the 100 DTE range. Next, how do we pick each strike? As I mentioned, we are buying one put, we are selling one put for our put debit spread, and then we are selling a put that's going to finance this. So the put that we're buying tends to be bought around the 25 delta level. So you're going to buy it around 25 delta. And the one that we're selling tends to be a 23 delta level. This creates our put debit spread that gives us downside protection. Then we pay for it and make our profit from what is a 10 delta put. This way, we collect enough money to offset our losses and generate a decent return while also still being very safe, because the 10 delta in theory gives us a 90% win rate. So that is how you structure the trade. Now, when and how often do you enter the trade? Entering the trade is going to be based on your account size. I'm going to use a $100,000 account size for easy numbers. If we have a $100,000 account, No more than 30% of it should be in open and active trades. We should have money set aside. Now, there's other things that I teach my coaching clients that you can do with that money that's set aside, put it into bonds and things like that so that it's accruing interest and making money while it's sitting there. But 30% of it should be in trades. So like $30,000 should be in trades for this instance. If we have 30,000 in trade, and one of these trades costs about, let's just say for easy numbers, it's not this high, it's more around 6,000. But let's say it costs about $10,000 to put on one of these trades. That means I can have on 3 of these trades at a time. So that means if I can have on 3 trades, I'll probably be doing a trade a week. So I'll be entering a trade once a week, and you can pick any day you want. So maybe Wednesday because it's the middle of the week. So once a week on Wednesdays would be the entry frequency of this trade. If you want to optimize your entry, you could also enter on red days instead, and that's going to increase the amount of credit you're collecting, and that's one way to do it. Now, exiting is following a simple set of rules. We're going to close the trade once we hit a 50% profit on the overall position, so a 50% profit, or between a 200 to 300% stop loss. Now, why this and how and which one should you pick? First off, I like going with a 50% take profit because it allows me to close trades faster, which means I have less trades open because they're closing more frequently. Why do I want to have less trades open? Because I have a lot of risk for each trade that's open. If the market turns around and I hit my stop loss on each, and if I have 10 trades open, that's a huge loss. But if I close these trades faster, I turn them over quicker, so I have less trades open so that when a loss does happen, it's on fewer trades. Now, which stop loss should you pick, 200 or 300%? The larger your stop loss, the higher your win rate because you give the trade more time to breathe, more time to move. However, depending on your profit, as in how much risk you're okay with handling, that should determine what level you're at. So a 200% stop loss in this example may result in a $5,000 loss per trade. A 300 may result in a $6,000 loss. So it depends on what you're more comfortable with on what you should be doing. Again, most people tend to be between 500%, 50% take profit and a 200% stop loss, and they roll it that way. Now, this is how you trade this strategy. As mentioned before, you have to trade it in a bullish market because that's when that works well. And again, a bullish market is defined as an uptrend, higher highs and higher lows. You see the market having higher highs and higher lows, this is your 111 trading territory. If you want to learn more about the 111 strategy, I wrote a book called the 112 strategy, which is the same thing as the 111, just more advanced. And so this book lays out everything you need to know about the strategy, and I linked it down below. Now, again, you can take everything you learned in this video, go apply it and make money. And if you do, please leave a comment down below because I would love to hear about your success. Anyways, that's all I got for you in today's video, my go-to bullish strategy. If you want to learn more, click the link in my description.